The next bit of brain to dump: investors will have better results if they resolve themselves to only sell overpriced volatility. It makes the most sense to sell things that are overpriced, not underpriced.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hello, Wealth Building family. Welcome to episode 15, OGCC setups. That's CC as in covered call, of course. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get that frequency bounce back we talk about, the more you grow as a trader. The second thing you can do is to get access to the video extra podcast episodes and posts that chronicle my covered calls and cash secured put trades that I'm making in my real brokerage account by becoming a paid subscriber. For the cost of one fancy Starbucks once a week, you'll get the video extras, my trades and adjustments, access to our monthly Ask Me Anything session, and a lot more. To get all this, just go to my Substack at wealthbuildingwithoptions.substack.com. That's wealthbuildingwithoptions.substack.com, and subscribe to the monthly or annual subscription. Today, we're tuning the dial to higher frequency trading. We're going deep into the real classic hands-on way to actually trade covered calls. It's important to master the tried and true OG technique to set up a rock-solid covered call. We must move beyond the basic textbook examples that we talked about already and learn when and why covered calls are typically used, what stocks they work best for, what an ideal setup is, and what criteria go into the decision-making process. Let the brain dumping begin. Generally, covered calls are traded on stocks or ETFs already owned that are non-volatile. This makes it pretty easy to start off with a list of which stocks might be potentially good candidates for overwriting calls. Already owned? Check. Non-volatile? Check. Covered calls work best on stocks over $30 a share. Options are priced as a percentage of the stock. So a $10 stock might have options trading at 10 or 20 or 30 or 80 cents, depending on how far in or out of the money they are and how much time there is until expiration. Whereas a $500 stock might have options trading for $1 or $5 or $20 or $40. If the stock is below, say, $30 a share, the options are usually so low priced that the bid-ask spread makes up too big a percent of the cost of the trade, because those small bids and offers, percentage-wise, are a bigger percentage apart. Commissions and fees are disproportionately costly as well with those. If you're trying to make 20 cents by selling a covered call and you pay $1 a contract in commissions and fees, you lose 5% when you get into a trade and maybe another 5% when you get out. Again, that's depending on how the commissions are structured at your specific brokerage firm. The next bit of brain to dump: investors will have better results if they resolve themselves to only sell overpriced volatility. It makes the most sense to sell things that are overpriced, not underpriced. This evaluation is accomplished by analyzing the volatility discussed a little bit so far in this podcast. And I'm going to share quite a bit about it today. Next, avoid earnings announcements. The session immediately following the company's earnings announcement and accompanying conference call, that's often the most volatile trading day of the quarter. While it can be tempting to sell the juicy implied volatility premium that's common leading up to an earnings announcement, high volatility in the stock price, it's not ideal for a covered call setup. There's too much risk to the downside, and it's hard to make up lost profits if the stock blows too much above the strike price. Oh, look, there's another piece of brain right here to dump too. Trade only options with liquid spreads. Selling at or near the bid and later buying at or near the offer is typically the biggest cost to investors when it comes to option trading, any type of option trading. This cost is called slippage. The tighter the bid-ask spread, the lower the slippage cost. Ideally, use what I call the 10% rule. The 10% rule states the offer should not be more than 10% higher than the bid. So if the call is $2 bid, the offer shouldn't be more than $2.20 offer. 10% more, right? It's got to be less than 10% more. Stick with that guidance for most situations, and results will be noticeably better. Next, balance the strike proximity. The strike proximity is how close or far the option is from the current stock price. And we call this moneyness too, if you want to get, fancy. Strike proximity will come into play as we talk about objectives, and so that's just in a couple of minutes. Hang tight. Finally, think it through. Make sure adding the short call makes sense and fits into your overall investment plan for that underlying stock candidate. I will share some specific guides and rules. I'll drop some metrics on you to measure the quality of each covered call trade. We will get into the minutia, but the options pricing model can sometimes produce some unintuitive option prices time to time. Step back from the trees and look at the forest and think, does this make sense? Does this help my overall trading plan? And to determine what the plan is, we need to know our objective. Think of a plan as the recipe. Well, in order to have a recipe, we need to know what we want to make for dinner. Think big picture first. What is the objective? Then we can formulate a plan. There are two objectives an investor may have for trading a covered call. The investor can be trying to skate or to trade. Skate or trade. Those are the two objectives. Now, the first one, skate, is a very simple and almost crude approach, but it can work great. It's a simple, good, old-fashioned, pure premium grab. The investor owns the stock and sells a call, hoping to skate. And skate means, by the way, if you don't remember, the option expires worthless. The investor gets to keep the premium and move on. No assignment. Basically, the investor just wants the premium to squeeze a little more juice out of the stock position, which again is a stock already owned. Let's drill down on this first objective, the skate objective. And it's looking like the amount of time I think this is going to take means that we're going to cover the skate objective in this episode and cover the trade objective in the second part next week. There are a few criteria that are important to being successful with the skate objective. First, if it's the investor's intention to skate on the call, meaning to not get assigned, he or she will want to choose a strike far enough away from the current stock price that it's unlikely to get assigned. They would want a strike that they believe the stock is unlikely to rise above by the expiration date. They might even want to sell a strike even higher than they think the stock can get, just in case. They might want some, what John and I call wiggle room, enough room for the stock to go up before getting assigned. Now, you can't just go and sell the highest strike available. A strike super far out of the money may not have a reasonable enough premium to make it worth selling. A very far out of the money call may, in fact, not even have a bid at all. When you're trying to skate on the call, you always face the same balancing act. You want to sell a strike high enough to have as much wiggle room as possible, but you want to sell a strike low enough to get as much premium as possible. It's always this balancing act. One of the simplest ways to start out approaching strike selection, and one that I find useful, is to sell calls on stocks I own that have resistance on the stock chart. And again, this is if I want to skate. Because covered calls are strategies that benefit from time passing, I find the best time frame to use on a chart is a 6-month chart time period with 1-day candles or open, high, low, close bars. I personally prefer to use candles. So let's take a minute first and talk about why I like candles. You can look at a whole bunch of different ways to look at a stock chart. There are what you call line charts, and that just is like a line that connects closing prices, and there's just one data point at each point on the horizontal axis. You can also load up what you call mountain charts, which, truth be told, are just line charts with the bottom underneath it colored in. Basically the same thing. But bar charts and Japanese candlesticks, or most traders will just call them candle charts or candlesticks. Bar charts and candlesticks, they are the most popular. And it's because they have more data. They have more useful information. They have 4 main data points, but a couple other can be extrapolated out of there. They have the opening price, the high of the period, in this case the day, the low of the day, and the closing price. And you can tell if they're up on the day or if they're up from the open as well. And they're a little bit different with bar charts and candlesticks. With bar charts, which are basically a vertical line on the chart for each day, okay, because we're talking about days. I mean, it can be for any period. Could be a week, could be 15 minutes, could be 1 minute bar, whatever. But we're talking about days. So with bar charts, it's basically a vertical line for each day with a notch to the left for the opening price and a notch to the right for the closing price. So if the notch that goes off to the right is higher than the notch to the right on yesterday's line, well, then it's up from yesterday, right? Because today's close is higher than yesterday's close. That said, if the notch on the right is up from today's notch on the left, well, then it's up from the day. And if the notch is below there, then it's down from the day. And it could be up from yesterday's close, but down on the day and vice versa. So this is this extra data point that is actually kind of important. Now, candles show the same stuff, but they're color coded, which I like because green, well, you can kind of make them any color you want. Commonly, it's green and red, and that's how I keep mine. But green is up from today's open, and red is down from today's open. So that's just what it is from today's open, what it is on the day. But if it's up from yesterday's close or down from yesterday's close, then you have to compare the closing prices. But that's very, very easy to identify if you know the color coding. And just a little aside, not to digress too much, but I don't know. I like to throw some fun facts in there. When I was, this is a few years back, I and John Kamisic, we spent a lot of time traveling to China when they were first listing options. Like they wanted to learn from the best American option traders, right? So John and I would go over there and talk options. They would hire us to go over there. So interestingly, I spent a lot of time talking to these folks. Interestingly, on their charts, red was up and green was down because, they like red. That's their flag. That's red is a positive thing there. So it's up was red. Very, very strange and confusing as a chart. I mean, if you're going from living in America to trading to living in Beijing and trading, you're going to get confused pretty easily. But anyway, digression over. All right, let's get back to time frames, okay? I said I find the most useful time period a 6-month chart worth of data and daily candles. Any shorter intraday time frames don't really add value to covered calls anyway. To other types of trading, sure, they totally do. There should be at least 2 price points on the chart to connect horizontally. So, like about the same price, a point at $60, a high point at $60 and a different high point at $60 before then, which are what we call inflection points that we can use to observe resistance. More than 2 such inflection points would be even better. So again, I know we talked about this in a previous episode. It was one of the earlier ones, but let me remind you, an inflection point is 2 or more points on a stock chart that are either peaks, so like points at the top of the chart that are at the same price level, or troughs, points at the bottom of a chart that are at the same price level, that you can connect either above the chart for resistance or below the chart for support. So that's how I determine my support and resistance levels. Are there horizontally equivalent price points that are inflection points that I can just draw a straight line through? With resistance, again, those are the peaks that are above like all the other pricing data on the chart. So you can visualize this in your mind. And in my opinion, it's not really a perfect exact science. Different people use different methods to determine the inflection points. I personally use the candle bodies mainly for these inflection points because during the day, throughout the trading day, there can be some noise. The stock can get up to a level and maybe it trades above this level where there actually is a lot of sell orders, but the traders who are trying to sell, they back off their orders to make it look like there's not a lot of orders there so they can let people bid the price up and then smack it down. There's just a lot of noise because there's a lot of technique involved in trading to be able to get the best price. So I think that noise makes using the wicks less reliable, which is why I like to use the bodies. It's just a personal thing. Other people might think differently. And you're free to. Okay. So what really is resistance? All right. Now I just kind of referenced this a little bit, but let me dive into this. Resistance is where sell orders have been in the recent past. Okay, how do we know that sell orders were there? It doesn't say, oh, there's an order here or anything. How do we know? Well, we know because it traded at that price. So there were buyers buying at that price and sellers selling to them at that price. There was a trade. There were buyers and sellers. It transacted. But here's the thing. If there is resistance on the chart, the buyers couldn't buy all that was offered there. They bought, they pushed the price up all the way to the point where there was a lot of volume being offered at a specific price, and there weren't enough buy orders to take out all the offers. And that is how resistance is established. And it's just the opposite for support, Buyers just simply couldn't buy all that was offered by the sellers, or else the stock would have continued to rise, and it didn't. It came back down. So stock charts are a map of human behavior. It's a record of what buyers and sellers actually did based on their opinions and studies, which, if you think about it, it's kind of cool, right? In fact, here's what I'll say about a map of human behavior. Do you know what the best school in the world for economics is? I don't know. Some people might have different opinions here. It depends how you measure it. And I'm a little biased because what I'm going to say here is the University of Chicago. Arguably, maybe the best school in the world for economics studies. At the University of Chicago, the Department of Economics is in the Division of Social Sciences, right? I bet you didn't know that. Not the business school. It's in the Division of Social Sciences is where the economics department is. And it kind of makes sense, right? So anyway, back to resistance. We use resistance to gain an edge with the assumption that there's a better than not chance there will still be selling pressure at those same inflection points. Now, there's no guarantee the sell orders are still going to be there. And there's no guarantee that the buyers won't win out this time and buy up all the supply that's there, pushing the price higher through that point this time. But it's a nuanced inference from the data that we have to work with. And empirically, it gives a chartist somewhat of an edge. That means that the covered call seller is at least a little more likely to skate than would be if there was no resistance. And even if it's just a little more likely, that is an edge that we can put on our side, and it makes it more likely that we make money. And you just add up a few little things that make things a little more likely, and man, you have got a trading system. Now, the next thing we want to put on our side with a covered call especially, but not only when we hope to skate on. Okay. So we could be for covered calls that we hope to trade out of a stock. Also, the next thing we want to put on our side is implied volatility. Well, there's typically a risk premium associated with options, which we've talked about in previous episodes. It's not always there. Sometimes, instead of implied volatility, which you'll sometimes hear me abbreviate, by the way, as IV, sometimes instead of IV being overpriced, which means options are overpriced because IV implied volatility is like the relative cost of options. When it's high, option prices are high. When it's low, option prices are low. So when IV is overpriced, option prices are overpriced. So sometimes instead of IV being overpriced, it's actually underpriced. That is not an optimal time to be selling options. To check for overpriced implied volatility, you have to study three things. And lucky for you, I came up with a system on this. And it's called the 1, 2, 3 volatility analysis. It is 3 simple steps. I'm going to do the old, I'm going to tell you what I'm going to tell you. I'm going to tell you, and then I'm going to tell you what I told you. All right. So the 1, 2, 3 volatility analysis is this. Compare current IV to the IV over the past 6 months. Compare the current IV to the current HV. And forecast out implied volatility, making sure that you think it's not going to rise in the future. That's a tricky one. We'll talk more about that. All right. So again, first is the relationship of the current implied volatility to the implied volatility over the past 6 months. And the best way to compare implied volatility to itself is by using a volatility chart. Implied volatility charts are typically set up as an indicator underneath the stock chart itself. Second thing, you would want to study the relationship of the current implied volatility to today's historical implied volatility, which I'll also call HV. So this one is a little more nuanced than just what I said there, because each option has its own unique implied volatility level. So you would want to use the implied volatility of the specific call that you're considering selling as a covered call. So this is the IV of the individual option that you would get from a column in the option chain, the implied volatility column in the option chain, which, if your broker lets you customize your option chains, that should be one of the columns. That should be one of the columns. So, okay, hold on a second. Wait a minute. So if every option actually has its own implied volatility, and on the volatility chart, there's an implied volatility line on the chart, well, what the heck is that line? What exactly does the IV line on the volatility chart measure? Well, let's talk about volatility charts for a moment. In simple terms, IV on the volatility chart is the 30-day implied volatility. And that can be customized. 30-day is the most common, and it's usually the default. I mean, you could have it be 10-day or 90-day or whatever, but it's usually 30-day. So generally speaking, the IV on a volatility chart is the 30-day implied volatility. But the question is the 30-day implied volatility of what option? And what if there's not an option listed right now that expires in exactly 30 days? Then which one is it? Well, the developers who create these volatility charts use a hypothetical fitted 30-day implied volatility that consists of the data, the implied volatility data from both calls and puts that are at the money and some that are out of the money and probably even some that are in the money. And I say probably because the developers can program it however they want, to extrapolate their version of a 30-day volatility. They're all pretty much the same, but they don't necessarily have to be identical, and they're not. So, okay, implied volatility of calls and puts in, at, and out of the money. And presumably, 29 days out of a 30-day month, there's not exactly 30 days until expiration when you're reading the chart. So the formula is also going to take options expiring in the expiration closest to 30 days, but with less than 30 days, and options in the next expiration greater than 30 days. So the platform developer creates this big formula that takes all this into account to combine all these data points to get just one single Frankensteined together imaginary 30-day implied volatility. The historical volatility, HV, which can also be called realized volatility, which I'll do sometimes. That on the chart, well, that's way easier to grasp. The formula takes the closing prices of the stock for the last month, usually. Again, that could be anything too, but for the last month is generally the default. And then they find the standard deviation of all those closing prices from the past month, take that standard deviation and annualize it, which basically makes the standard deviation of the last 30 days representative of a full year, like as if the full year was like the last 30 days. And then they just plot it on a chart for each trading day. Because they're around 30 days in a month and options can change in value at any time, the 30-day implied volatility, IV, that is a true 30 calendar day value. Counts holidays, counts weekends. Because value can change on holidays and weekends. The price can't. Because there are about 21 trading days in a month, I personally say it makes more sense to use 21 days for the HV calculation, which some platforms allow traders to select or code on their own. If the objective of the options pricing model is to accurately value options, well, it follows that if you have no reason to believe the stock's future volatility will be different than what it's experienced in the recent past, the last month, the volatility input into the pricing model that's being used, it should be the same as historical volatility. And we talked some about this in episode 9. If you want to refresh your memory, give episode 9 a listen to. If the IV of the specific call option the investor is considering selling is above the historical volatility on the chart, well, that is an indication, one of 3 indications we care about. It's an indication based on this second criterion for volatility analysis that IV is overpriced and that the call is ripe for selling. The investor can get an edge in that case. We find the implied volatility of the individual call option in what we call the option chain. The option chain is a matrix displayed typically on a brokerage platform, but you can get it from other sources too, that lists the option prices and other numerical data like the Greeks and implied volatility. Most brokerage firms have that as a column or allow you to customize it to add those as a column. And for those of you who are paid subscribers, you've seen some of the video extras where I show that. Typically, investors would logically prefer to sell a call with the strike price at or above resistance to increase the likelihood of skating, right? So if resistance is at, say, $245 a share, right? That's where there's a few inflection points. You can draw a straight line across connecting them. Then the investor would look at selling the 245 calls, or even better, the 247 and a half calls, or maybe even consider the 250 calls if you can get a good enough price to get a little bit of extra wiggle room in case it goes a little bit through resistance. But you'd really only be excited about doing so if those 245 or 247 and a half or 250 calls had an implied volatility in the option chain that's greater than the historical volatility from the chart, from the we call it a vol chart to be short. I'm giving you all this lingo in this episode here. From the analysis thus far, if the IV is in the top half of the 6-month range and the calls IV in the option chain is above today's historical volatility, well, those are two criteria that provide a pretty good case so far for the calls being overpriced and thus good candidates for selling as covered calls. The third and final criterion that will help you identify overpriced implied volatility is to confirm there is likelihood that between the time the trade is put on and the expiration date, there's no reason to believe the stock should become more volatile. Now, this is the trickiest part of the three criteria for sure. We're really looking at a couple things here. Specifically, we care that the HV is not expected to rise above the current IV of the call option candidate, the specific call. The data that would lead to such an assumption would be the existence of a planned volatility event, like the stock having an earnings announcement and the conference call that goes along with it. Or it could be another type of scheduled event, like maybe the monthly non-farm payrolls report, or even a Fed announcement when there's some uncertainty as to what the Fed might do. If one of these things falls before expiration, that could indicate, hey, there might be a pretty good jump in historical volatility. If HV were likely to increase to a value higher than the IV of the option, it would nullify the assumption that implied volatility is overpriced. Even if it's the implied volatility is high in the context of the first two volatility analysis criteria, right? So as options traders often say, sometimes when volatility is high, it's high for a reason. These three, okay, so let's recap here. Let's recap. What are the three steps in the 1, 2, 3 volatility analysis? Step number 1, if today's implied volatility is above the implied volatility of the last 6 months on the volatility chart, that is one indication implied volatility is high. 2, if today's implied volatility in the option chain of the option you're thinking about using is above today's historical volatility, that is a second criterion that could indicate that implied volatility is high. Number 3, if there's some reason to believe, particularly like a scheduled volatility event before expiration, that could lead historical volatility to jump up higher through above implied volatility, well, we don't want that. We want everything to be cool, copacetic, low HV, low historical volatility, meaning the stock doesn't move that much. These three volatility criteria, along with the presence of resistance on the stock chart and the other guidelines that I shared earlier at the beginning of the show as well, these things indicate that the covered call is a go. These are the tried and true OG covered call setup criteria. And that wraps up the skate objective and everything else we covered before I started talking about the skate objective today. Whew, that's a lot of stuff. You deserve a break. Or hey, if you're listening to this in the future and there's other episodes after it, well, then just keep binging along. Binge until your head explodes. No, don't do that. But binge until, you're ready for a break. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app and leave a review, please, 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 please. When you do, you will be the first to hear episode 16 coming up next week. I'll see you then, and in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.